right, welcome to the Market of the Moment for the week of July 4th, 2022. Quick look at this week's market stats. I've really just got our 4 counties here today. So we haven't looked at these numbers in 2 weeks, so quite a bit has happened in those 2 weeks. That's why we've been doing this updates, so we could be on top of it when it happens. So in Collin County this week, we are under list price for the first time since I think we started our updates nearly a year ago. Collin County, the list sales price to list price dropped to 97.1% in the last 7 days. That's nearly 3% under list, and that is down 10.8%. That's not 0.10.8 of a percent, down 10.8%. So obviously our prices were up on our last one. I think we're at 109% over list price in our last update. So
yeah, and that's still a little. We'll wait. So for the the millions of people out there watching, we appreciate your support. Yes. We have some key information coming out tomorrow, so we'll be sure to. Yes. For whatever reason, there's a lot of. Different
next week's update, I think, is going to pull everything back together. I think we'll see things more like we have seen and not these drastic jumps. Don't know if it's school getting out, 4th of July, but maybe a bunch of new construction got closed right at the end of June. I know we were getting pushed to close a few of them at the end of June. The builders were really pushing to get them off their books, so I can't imagine those were the only ones. So that could have a lot to do with some of these things. Inventory in Collin County went up to 2.4 months supply, which gets us closer to our 6-month supply, which would be a healthy market. That jumped 1.1 month, which tells me builders are getting more inventory on the ground. So this week, new listings, there were 402 versus 586 2 weeks ago. And we had 515 sell in Collin County versus 353 2 weeks ago. So jumping over to Denton County, once again, list price, sales price to list price dropped 2.2% under ask to 97.8%. That was about 8.7 or 8.9% from 2 weeks ago. Supply jumped in Denton County by just over a month's supply. So now it's at a 2.3 month supply in Denton County. And new listings there, 338 new listings versus 2 weeks ago, there were 529, sold 526 this past week versus 323. So look at both of these categories kind of flipped. Dallas County dropped to nearly 3.5% under list at 96.5%, 8.7% from 2 weeks ago down. You got a 2.7 month supply in Dallas County, 1.6 months jump there over a month and a half. And new listings 588 versus 723 2 weeks ago. And we sold 656 versus 506 2 weeks ago. And jump into our rural county, Grayson, which it had been starting to trend down our last couple reports, and we said that we'd probably start feeling that closer to home. So Grayson County dropped to 94.9%, just about 5% under list. It's kind of where it was at, I think, when we started our reports a year ago. So that's down about 5.2%, not as much as our other counties because it had already kind of started this decline a couple weeks ago. 3.6 months supply in Grayson County. That's up a month and a half. And new listings 55 versus 91. So that's nearly cut in half from 2 weeks ago. And our solds pretty much stayed about the same, 60 versus 52. So some of the reasons why some of these things happening, it's as Chris has been talking, just the same way with rates. You're hearing inflation, you're hearing recession, you're hearing all kinds of different economic terms thrown around. You're hearing that the housing market is crashing. all kinds of things, I think, lead to some of these numbers and some outliers in this particular report.
Yeah.
But let's get down, let's look at the truth of the matter and what really happens during these times. So first, days on market has ticked up in all of our counties. We were on about a 5-day days on market, and that did jump. But we want to look at, since July 2016 up until June of 2022, what days on market in the United States has looked like. And if we go all the way back to that July of 2016, you could see we were at just about 70 days on market as an average. And then at the beginning of the year, and you can see at the beginning of the year, this always ticks up. So that tells us real estate is somewhat seasonal. In the middle of that, which is your summer months, it's down at its lowest levels. Yep. Which that's the, that's pretty when normal. The market's normal hot. So, yep. This is just pretty much a typical real estate pattern, seasonal, with days on market going up in the winter and being down lower during the summer. But what I'm looking at more is as it goes across here, we hit our recession in January 2020 here, or excuse me, the first quarter of 2020 after the pandemic. We have a recession, and our days on market still during that time was at pretty much the average, maybe slightly over what it averages through there. You could almost draw a straight line across the bottoms and the tops of these. So my point is, when we get here to the first quarter of this year, obviously inventory was at an all-time low. The market interest rates were low. And so days on market were obviously very low. This runs up to June of 2022, and you can see it starting to tick back up. But days on markets generally here in Dallas around 62 days on market. So anything under that, I say, is good. And, seasonally, that's going to be, 15 days on the market versus maybe one that goes 90. So it averages out to in the 60s. So
I think the biggest component there too is, we've been so used to over the last, 2 years, seeing homes on the market for 5 to 7 days, if that, right? Maybe 5 to 7 minutes, who knows? But for the most part, we've just been used to the 3 to 5 days on the market. It goes under contract and then it closes in 30, right? Your average, again, if a home sits on the market for 30 to 60 days, guys, that's normal.
Yeah, exactly.
So what we've been experiencing is, again, the flaming hot housing market that has been, for much of the country, especially here in North Texas. But again, just because homes are sitting for a little bit longer doesn't mean that the housing market's going, is going anywhere. So,
this week we put a house on the market, just as an example, put it on the market on Friday at 1. Took it off the market basically for showings Sunday around 5. So about 36 hours this home was on the market. We had 31 showings in that 36 hours. We received 15 offers in that 36 hours. And, we executed $40,000 over our list price. So depending on what part of the market you're in, if your home is priced right, that's going to have a lot to do with it. But my message there is homes that are priced right and they're kind of fit in that box and that probably 350 to 250 range, they're going to be the ones that bring the days on market average down. Definitely. Next thing I wanted to look at was, I'm constantly getting asked, is this a good time to buy with interest rates and inflation and the chance of a recession and these things? And my answer has always been yes, yes, yes. If you can buy now, you definitely need to be looking at it. And so I wanted to pull this chart up here. This shows the U.S. price index and the percentage change. This dates back to the mid 90s. And it basically, up until the mid 90s, housing, wasn't seen as a great investment. because it pretty much tracked, as you can see at the far left of this chart, it tracked along with inflation. Housing wasn't something where you put your money to beat inflation in the economy. But as we got into the mid 90s, you can see that the price index and housing appreciation, went up more than our consumer price index, or what we basically gauge inflation by. So, believe at the far right of this, it shows the last glimpse right after the recession from the pandemic, and you can see another big spike right there. I think it went from 180% to 193 or something like that.
Yep.
My video screen blocking it from me. I don't know if you can see it or not.
Yeah, 193 was the peak right after.
So yeah, so and this would be, obviously a chart I would use with clients that were asking me, what is housing, going to do during this inflationary time? And it's basically going to trend like everything else. If the price of gas goes up, it looks like the price of housing is going to go up as well. Anyway, it is a good time to buy. It's not going to, get better anytime soon, if ever. We've been showing charts week after week, showing historical data on the housing market and interest rates, what the government does to control the economy. And all of these charts point to housing is going to outperform, pretty much every other investment on the long term. So I would get in while I can get in. Once again, this is estimated home price appreciation over the next 4 to 5 years. We're still expecting close to 10%, maybe a tad more here in the DFW area, 9.3% nationally. And then we get back down to what I've been telling people, a leveling off of the market. Not a drop, not a downturn, but back to, as Chris said a little earlier, reality. We've been spoiled little kids these last several years, and it's just going to get back to normal. So basically averaging probably close to 4% to 5% here in the DFW area. I'd say that's probably 6 to 7% again. So home is going to appreciate. Interest rates is eventually, historically, we've seen through the charts, going to drop. They're going to come back down. You're going to have a chance to turn that 5.25 back into a 3 or 4 here someday. So anyway, get your house, get the appreciation, get rid of the higher interest rate later, and let's go get a home.
In mortgage rates. So last week we actually, we got a little bit of a reprieve from the high rates that we had previously seen, right? So rates came down I say a decent amount, because we were in the, it's as of like 2 weeks ago, rates had crept up into the 6.25 to, almost 6.5 range. And then this past week we dropped down to the 5.25 to 5.5 range. And then yesterday happened, right? Yesterday happened. There's still a lot of, it's amazing to see the impact, or the ongoing impact, of inflation in the markets, right? In the stock market, in the bond market. So so thankfully we didn't give up all of the gains that we received last week, but we gave up about half. And we'll talk about that in a second. But so current mortgage rates are in the 5.5 range to about 5.8 on a 30-year conventional. And gosh, it is so hard to predict what's going to happen. Some of the sources that I follow, we're expecting rates to continue to tick higher for the next 2 to 3 months, right? Is what we're now hearing. And then and that is coming on the heels of the fact that we may already be in recession, right? Or pretty close to a recession, right? And there's a lot of different things that we've talked about. One of the key indicators is two back-to-back quarters of negative GDP, right? The gross domestic product numbers that come out. So so the second quarter numbers aren't out yet, of course. So that's, that's that's causing a pause there. But again, if we're already in a recession, or we'll be going into one, shortly, there's some speculation that rates may be coming back down a little bit towards the end of the year, which is, somewhat contrary to what we were hearing previously, where, we were going to be up over 7% by the end of the year. That seems like it may happen in the next 2 to 3 months. We may get not to 7, maybe the mid 6s again, 6.75, something like that, and then we'll see them kind of taper back down. But it is we got to keep our heads on a swivel over here, because it's moving really fast. But yeah, again, what we're advising right now is I'm doing a lot of 60-day rate locks. We have a program where we can lock your rate now without having a property under contract yet, for 30, 60, 90 days, and really anywhere in between. So 30, 45, 60, 75, 90. So there's just some good opportunity to lock in numbers now, instead of waiting. Because again, if rates go up to 6.5% in 3 months, well, there's a good bet that you're probably already locked in at 5.75 or something like that. So yeah, it is the importance of following this on a weekly basis, is because there's just, from one week to the next, there's just so much volatility. So going to the charts here, we're looking at the mortgage-backed securities charts. We're looking at that July 5th date. And there was, again, we're talking about the volatility in the market. It was still on July 5th, we closed up. So if we look at the last, essentially that green box there, we still closed in the green, which is positive, right? Green is good, red is bad. But yeah, essentially yesterday, so that next day, which is July 6th, again, we started the day off at I think pushing over 101, and then ended slightly over 100. So that was just a huge drop in mortgage-backed securities, which again sent rates up, 1/4 to 3/8% yesterday. We actually had 3 rate changes yesterday, in a single day. So again, there's the interesting part here is anytime you see big upticks or downticks like this, we're always looking at the next that next line, right? Which we saw the mortgage-backed securities were pushing down on that 25-day moving average, right? That kind of copper line, I guess, that we're seeing going on that downward trend. So they hit the 25-day moving average, or got pretty close to it, felt, got some resistance, and then bumped back up. So thankfully, they didn't get below the 25-day moving average. If they do, and they're again, we may see that it gets below that, there's a lot of room, like almost 100 basis points to the downside, which could mean another 3/8 to 0.5% increase in interest rates.
Wow.
So the importance of working with somebody, of talking with somebody that monitors this on a daily basis, right? Because this is a daily, and 5 times a day, 6 times a day, like we're doing now, just to make sure there's no significant changes. As of right now, we're down 11 basis points. So we're sitting just a little bit over 100. We're still at about 100.25, which is pretty close to what I think it ended at yesterday. So, so we can say that it's relatively, at this point, it's relatively flat, right? So we're not going to see any upticks or downticks. But at this point, the market's almost closed, so there shouldn't be, too much of a change. Tomorrow, we're getting the JOLTS numbers, the job openings and labor turnover numbers. So it's, those are obviously jobless claims, which is unemployment, right? That has an impact in market. So we're waiting for those numbers to come out tomorrow. BLS jobs report. So there's just several things that are on the horizon that could impact mortgage rates, right? And for everyone that has money in their 401k, we're not looking at it right now. It's pretty ugly. Depressing. Yeah, pretty ugly right now. But again, such is the market. So,
well, with rates going up, and we talked about housing appreciation and things of that nature. So a lot of people talk about, well, I'll just rent. So we wanted to take a minute to talk about what it looks like if you rent versus being a buyer. So let's take a look at this chart and I'll let you talk about it.
Yeah. So, so in the past, when mortgage rates were at 3%, this on a monthly basis perspective, right, looked more attractive. So your monthly, what you're paying in rent versus what you're paying in a mortgage was pretty darn close. And now because rates are in the, this is, I think we're averaging here, estimating here a 6% interest rate. The payment's higher, but again, we'll kind of just talk through this. So this is a $350,000 home purchase in the Collin County area versus obviously renting also in the Collin County area, right? So this is just picking average of rent costs here in the Collin County area. So if you're purchasing a home at 350, putting minimal amount down, your total payment, including, property taxes, home insurance, mortgage insurance, all of that, all that stuff is in the probably $2,700 to $2,800 range. Now this includes about $145 of maintenance and repair, right? So just in the event that you have to have something done, but most likely your actual mortgage payment itself is somewhere in the $2,600 to $2,700 range at this 350 price point. Yeah. So given that same, that same home size, you're renting, right? So that next box is your first year in rent, which is right around, $2,000 plus your insurance costs, which is, roughly $30. So there's about a $500 difference in just the mortgage payment compared to a rent payment for that first year. But again, as we know, with home values continuing to go up, obviously rent costs going up, where it starts to significantly pick up steam. And the difference is, that first, we're talking about maybe a 9 or 10 year period where that your mortgage payment is staying, pretty close to the same, right? It may go up a little bit because of property taxes or whatnot, but the standard annual rent increase is just shy of 4%. This past year, we saw a 15% increase in rent, right? So this is just giving average numbers. The cash flow, talking about cash flow difference is if you're renting, that's a negative $54,000 in just the difference in cash flow, right? And that comes from the appreciation gain that you're gaining with a home and appreciation versus the amortization gain. So that's where these numbers are coming from. So we touched on it a couple of weeks ago, just this idea of building wealth, right? And how you're able to do that. And this is really step number one, right? Now, again, if we're going through numbers and you're like, hey, 350 is out of my price range. Well, hey, let's look at what does 225 look like? What does 250 look like? You may have to purchase a little bit further out. But at the end of the day, you're still building wealth, right? You're building equity. Home values, like we've seen, are not, if priced appropriately, are not going down, right? I think a lot of the numbers that we're going to transition to here talk about downward numbers, but it's again, when you really put pen to paper, just the overall net gain in purchasing a home in overall wealth, right, is huge. So
yeah, well, we'll jump to this slide real quick and go ahead and talk about it. Might look at it again later, but it fits in here as well. So Chris is talking about appreciation over time. This is a forecast going out to 2026, and you see, averaging about a 4% gain, the next 4 to 5 years. Here in our Collin County, DFW area, I would expect those numbers to probably be more in the 6 to 7 range, maybe even up to that 9.3% range for our area, but very conservatively, I'd say 6%. So even though as your home's appreciating and your payment is staying the same, that's not happening for those that are renting. That homeowners is appreciating, but you're going to be paying more. As Chris said, you don't get to keep the same payment when you're renting. It's going to go up versus being a buyer. So now is still a great time to buy. Tell all of our clients, if you can buy now's a good time.
Yeah, I think that's the biggest thing, again, is education, right? We're just wanting to educate consumers, buyers, whatever it is. Looking back, homes or customers that went and put new construction homes under contract in 2020, right? In 2020, the housing market was crazier than it is now. Homes were taking longer to build. So we saw homes taking 12 to 18 months, right? From 2020 to now 2022, I mean, those homes have appreciated. A $500,000 home, if somebody got a home, if they locked in that price, right, in 2020, got a home under contract, is probably now is worth easily 750.
Yeah,
So
definitely.
that's again, that's the biggest thing, is we want to just, obviously be educating as well. Because if you don't know, you don't know, right? But obviously we're here to be a resource and make sure you know.
Definitely. Some of our biggest wins have been getting people under contract. Last year, some of them are just now getting ready to close, and they probably already got $50,000 to $70,000 worth of equity in a home as they move in. So, that's kind of how you would like for it to work. Make sure you're turning to Chris or I for all your real estate news. We're staying on top of it. You can reach out to Amy and I, 469-369-0873. Get with Chris at 214-734-1531. He'll get you qualified.
Oh, yeah.
And we'll get you in that next house.